Hello, I'm Clara Hermit and this is Mould on Markets, our regular look at the financial markets with Investment Director Russ Mould. Russ, how are you?
I'm very well, Clara. How are you? Lovely to see you again.
Yeah, I'm not too bad at all. I'm itching to get into this today though, so let's get started. So the FTSE 100 is inching closer to an all-time high and the America S&P 500 has set a new peak. So Russ, what is it that advisors and their clients should be thinking about?
Well, it's interesting because Japan's Nikkei 225 and the European stocks indices are at 7-year highs and they're rising quite nicely, particularly in local currency terms. And in fact, the UK, Europe and Japan are outperforming the US right now, but again, only in local currencies. As we discussed on the last time when you weren't here, once you adjust for the dollar, America's actually doing much better. It may be advancing a bit more slowly, setting lots of new all-time highs, and in greenback terms, it is motoring along quite nicely. So it'll be fascinating to take the temperature of both the S&P 500 and the US economy in the next couple of weeks, because we're due a whole raft of economic numbers from the States, and I think the market's attention is going to be particularly focused here.
So what's the headline figures that are coming up? Yeah,
we've got some really, really big ones. We've got things like the Richmond Manufacturing Index, but there's 3 overall I would really focus on. First, on Tuesday the 24th, we've got the Case-Shiller House Price Index. That covers 20 major American cities. And same day, we've got the Richmond Manufacturing Indicator. Both have shown some signs of cooling of late. Now, the Case-Shiller reading logs year-on-year changes across 20 big cities in the United States, and from a peak of 13% growth in spring 2014, that slowed to around 4.5% right now. So let's see what the latest reading is. Second, same day, we've got this Richmond indicator. Now, this is sort of a sentiment gauge, like other local guides, such as the Philadelphia Fed, the New York Fed, the Empire State, and all of those have actually come off the top and been a little bit, almost for choice, disappointing recently. So let's see what the Richmond says. That's gone from 20 in October to just 6 in January.
Okay, so that's 2. What's the third one?
That's the biggie. Durable goods order, Thursday the 26th, that comes out. Now, this has actually fallen 4 times in the last 5 months. Nothing like what you'd expect given the frenzied debate over whether the Federal Reserve is going to raise interest rates or not. Now, in the end, it's a very noisy, very volatile number. It won't pay to get too worked up by 1 month's figure, even though I'm obviously getting desperately excited by it. But the market will be looking for a return to growth after that 4 times in 5 months progression. As a final point, by the way, we've also got the preliminary 4th quarter GDP number on the 27th for America. Remember, the advanced number, the first estimate, was 2.6%. This is the first revision to that estimate, and we'll get another before the final number comes out in a few weeks' time. Now, 2.6% for the 4th quarter was a slowdown from 5% in the 3rd. It'll be interesting to see if there are any revisions up or down. Now, as a final point, again, I know I'm getting very excited about this, but remember, GDP numbers are backward-looking. So don't get too het up about them. Stock markets are forward-looking discounting mechanisms. They're interested in the future. GDP is by nature backward-looking. Advisors and clients should therefore focus on lead indicators, stock and bond markets, commodity prices, concurrent ones like sentiment surveys, durable goods orders, factory output, much more useful than trailing guides indicators like GDP, unemployment and employment.
Okay, thank you, Russ.
Pleasure.
And thank you for joining us. We'll see you next time. Goodbye.